So, any questions? No? Okay. So I was discussing yield to maturity. So when you invest in a bond, you pay the price, right? And then let's say 1, 2, this represent end of each year. Bonds usually pay semi-annual coupon payments, but let's say they pay each year, right? And then when you bought the bond, you paid the price. And then let's say they told you coupon rate is 5% annually, right? And if you invest one bond, what is the par value of a bond? How much? $1,000 is the par value. How much will you get at the end of each year? As an investor, $50. Very good. Right. So you'll get $50. Let's say the price was 1,000. If the price is also 1,000, what kind of bond is it called? Par bond or par value bond, right? And that happens when the market interest rate coincides with the coupon rate, right? Because if the market interest rate is higher, bond price has to be lower, right? So, and let's say you have $10-year. At the end of 10 years, you also get $50 and then $1,000 back, right? Okay. Now, right after you bought the bond, market interest rate may change, right? If the interest rate decreases, so when you bought, it is 5%. When interest rate decreases, then you reinvest, right? Because you have these coupon payments every year. And let's say there is no other investment that you can or you want to invest, to keep things simple. So you will have $50, you have to reinvest, right? So you will reinvest at that ongoing interest rate. And then how many years you will reinvest? 9 years, right? 9 years. And then similarly, this one will be again reinvested at the then interest rate, right? Prevailing, right? Okay. So if the interest rates rise, what will happen? You will be able to reinvest those coupon payments at a higher rate. Isn't that right? So, resulting in a higher return for the investor, right? Because you invested $1,000, now you are reinvesting all the coupon payments at a higher rate. So you will have a much higher future value, right? Than if you had invested those coupons at 5%. On the other hand, if the market interest rate goes down, you'll reinvest those coupons at a lower rate, which will reduce your return. Isn't that right? You guys following me so far? But that is just one side of this story. Another side of the story is, what if you don't hold on to the bond for the entire maturity? You need cash, you want to liquidate your position. Then, yes, if the interest rate increases, you can reinvest your coupon at a higher rate, but what happens to the price? Price goes down. Isn't that right? Price goes down. So although you are making money by reinvesting the coupon at a higher rate because the interest rate is higher now, but if you sell the bond at that point, you will lose value in the capital, the bond price, right? And the opposite happens if the market interest rate goes down. Bond price will increase, although you'll reinvest the coupon at a lower rate, right? So then, because of this, your return actually will change if you don't hold onto the bond for the entire maturity of the bond, right? And we have to keep all these things into consideration if we decide to sell the bond, if we decide to liquidate our position. Generally speaking, the longer the investment horizon, the larger impact of the reinvestment rate. You have more coupon, that those will be reinvested at a higher rate, right? So your return will actually increase. If you invest in a longer bond, okay. But if the interest rate increases, and if you want to sell the bond immediately, then the key determinant of the realized return is the price at which it is sold, right? Because you are not getting the higher reinvestment, right? You're selling the bond when the interest rate rose, so bond price decreased. So your capital loss will actually dominate than the reinvestment effect. You guys are following me so far? Yes? Okay. So this is the most fundamental thing when we talk about investing in bonds. So our investment horizon, reinvestment, and the capital loss. So the relationship between price changes and yield changes can be approximated as with this formula. So we all know that bond price is inversely related to the interest rate, market interest rate. One goes up, the other goes down. Okay, but how can we determine an approximate percentage change in bond price for a given change in the yield? We can use this equation. So in a very general sense, what is the price of a bond? Like from a discounted cash flow perspective, generally speaking, from a discounted cash flow perspective, the price of any financial asset is the present value of all future cash flows. Isn't that right? Regardless, we talk about bond, regardless, we talk about stock, right? So So when we want to find out the bond price when yield changes, meaning let's say yield to maturity increased by 1% or decreased by 1%. If we want to price the bond, what do we have to do? We have to discount all these future cash flows at the higher yield to maturity if the yield to maturity increases, or the lower yield to maturity if the yield to maturity decreases, right? That will be our price. And it's a long time consuming analysis, right? And we have to come up with multiple forecasts. So it will be tedious. And sometimes we want to also want to have a mechanism to quickly approximate the change in bond price or percentage change in bond price very quickly instead of running all the present value analysis, right? We will use that equation in that case. It has two things. You have probably seen this before. D, it is duration or modified duration. Simply, we call it duration. Another is convexity. And Y is the yield to maturity. Delta Y is a change in yield to maturity. So minus duration times change in yield plus half times convexity times change in yield squared. That will give us the percentage change in bond price. In that case, can you solve this problem using that equation?
You go back to the
Formula?
yeah.
Yeah, I can. Here's the formula here. So D is the duration, C is the convexity. You have a number?
Minus 0.0.9.
That is correct. Right? Did everyone get that?
Isn't one bracket missing? The last part.
That is a C. This one?
Oh, no.
This is a C. Sorry about my. Yeah. Good. You got it? Okay. Yeah. Okay. Got it? Okay. Now, can anyone tell why in this formula we have a negative sign in front of D?
Because you start with negative.
Yeah, but why does the formula have a negative?
Inverse relationship.
Exactly. Remember, bond price and interest rate are inversely related. So if I say the change in yield is positive, price has to be negative, right? I mean, the percentage change in price has to be negative. If I say delta Y is negative, 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 positive, the percentage price will increase, right? But note that convexity, it is positive. And I'll discuss what is duration and what is convexity in more details now. Before that, one thing to understand is fixed coupon bonds. Those that pay coupons at the fixed rate. We have, you will see we have formulas to calculate duration. There are different kinds of duration. We'll work with two specific kinds. One is macula duration, another is modified duration. That one is a modified duration, right? But for instruments whose cash flows are contingent on future events, like mortgage-backed securities, no formula exists. Rather, what we have to do, we have to calculate duration and convexity by valuing the instrument at different yields and observing the change in price. What does it mean? Cash flows are contingent on future events such as mortgage-backed securities. What is a mortgage-backed security?
Security backed by the market.
Exactly. Can you tell more?
So oftentimes it's for liquidity purposes because you can easily sell securities and mortgage-backed securities than you could just a bunch of whole loans or anything like that. And then yeah, they have different tranches for them.
Exactly, based on the risk profile, right? So what Preston is saying, so you have, let's say, these homeowners. They need mortgage, right? So they borrow money through mortgage. And who provides that loan? Banks, right? Let's say, right? Different kinds of banks and other financial institutions. Now, there is also another kind of bank. What they do, so these are individual mortgages, right? And there are many homeowners, right? Many homeowners. And there are many banks. Right? And every homeowner has a different risk profile. Some are more likely to default than others. So lending them money is riskier than others. That is what Preston was talking about, tranche. Now, so these are individual loans. They are packaged in a structured security. And what are the collateral of that security? All those houses. That is why it is called a mortgage-backed security. There are other types of structured products too. For example, ABS, asset-backed securities. For example, when you use a credit card, right? The bank is giving you a month of time, right? To pay your money due, right? What does the money come from? It is backed by some credit card loans, right? Now, when it says that these have contingent cash flows, what that means is most obviously or importantly, prepayment risk. So what happens when the interest rate goes down? The long-term interest rate goes down, mortgage interest rate also goes down. As a homeowner, what will you do? You want to refinance. And how does the refinance work? You go to your original bank, give him the money that you have outstanding, right? And you borrow at a lower rate from another bank, or maybe the same bank, because you want to borrow at a lower rate. As a result of that, what happens? So these mortgage-backed securities are sold to investors, right? They are exposed to the prepayment risk. Prepayment risk. Because when you invest in a mortgage-backed security, you are vulnerable to the homeowners prepaying their loan. Because if they prepay, you will get the cash when you don't need it. And you actually are getting back the cash when the interest rate is low. And you have to invest your cash flow at a lower rate, right? So that is what it means by contingent, yes.
So the cash the bank receive, is it a total cash agreed or?
You mean
Yeah, this is you
that
want to,
bank?
yeah, you want to refinance.
Yes.
As a
Yes.
homeowner,
Mhm.
and I want to pay because interest rates has gone down, right?
Mhm.
And I want to refinance.
Right.
And I want to pay the bank. Is it the agreed amount plus the interest or just the?
Yes. There are some costs involved.
Okay.
Yes. So
Okay.
you may have to pay slightly more to be able to refinance. So you will refinance when you see that refinancing at lower interest rate is
Okay.
better off
Okay.
than carrying on the current loan with a higher interest rate.
Oh.
Yeah, so there is a procedure you have to go with the bank. You can do that with the same bank or another bank. Okay.
And the mortgage-backed security you're talking about.
Mhm.
So the home is the security. Is that what you're saying? Or
So the security is basically, you can think of it a piece of paper. This is the security, right? And its underlying assets are all those mortgages. All those mortgages, right? These underlying assets are all those mortgages.
okay.
Yeah. And there are different parties involved. For example, one party actually sells the mortgages, another party combines it, another party creates the actual structured product. So the whole process is more complicated. The basic idea is when the interest rate goes down in case of mortgage-backed security, it is more likely that mortgage owners will prepay their existing loans, right? So as a result of that, that will affect the cash flows to the holders of those mortgage-backed securities. Holders mean the investors, right? Because all those money that homeowners get through their mortgage loan, where are they coming from? All those investors who bought the mortgage securities, right? And then, without going into the details, there are different kinds of risk profile, and that will also determine your level of return you can expect. So yeah, there are different kinds of structured products where cash flows are not as neatly defined as coupon bonds. As a result of this, we have to follow a different process to calculate duration and convexity. For example, this is the formula to calculate duration. This P minus is, let's say we are saying what will happen to the price if the yield decreases by 1%. P minus indicates that price.
It's decrease.
Bond price when the yield decreases, minus. P plus, bond price when yield increases. divided by 2 delta P. So that is the change in yield. P is the original price, the current price, right? And convexity is P minus 2P plus P plus divided by delta squared P. Okay. So essentially what you are doing here then, you're observing the price points at different yield levels and then finding out the duration and convexity. Now, duration is simply the percentage change in price arising from a change in yield, right? If we graph the price as a function of yield, duration is the slope of a line connecting P minus and P plus, and then divided by P. Convexity measures how the slope of the price yield relationship changes around P. Okay. Let's look at this graph. What this means is, so on the x-axis you have yield to maturity, and on the y-axis you have the price. Now the blue line, it looks like a straight line. It is not. It is actually curved. It is the actual price. But again, actual price requires a lot of work. You have to individually discount all the future cash flows and find out the price, right? To avoid that, we want to find out how to calculate duration and convexity, right? Because using both duration and convexity, we can find out the change in price. Now, this is the actual price change. Now, if you use only duration, what does it mean? Some of you look confused. Are you guys okay? Tired?
Okay.
You okay? So this is the duration part. So you see the red line? If you try to find out the percentage change in price, that means the new price after the change in the yield, using only this part of this equation, you'll get that line at different level of yield. Now see what happens if you do not account for convexity. Now this is your original price, P, right? At this level of yield. Now, if yield decreases, price increases, isn't that right? What is the new price after the yield decreased? This green is the actual price on the blue line, isn't that right? But what is the price estimated by duration? The point perpendicular, right, on the red line. You guys following me so far? Now comparing these two price points after the yield to maturity decreased, what do you see? Do you see an overestimation or underestimation? Again, blue line is the actual price after the yield changed. Now we are talking about this specific example. Yield decreased, right? From 5 to 4. Actual price is on the blue line. But without calculating the actual price, following the present value analysis, we estimated or approximated the price using duration only. That means using that component. And we found out this will be on the red line, isn't that right? Perpendicularly down, right? So which one has a higher price? Actual or the
Actual.
actual, isn't that right? So if you use duration only, your increase in price is underestimated. Isn't that right? But what happens in the case of increase in yield? Of course, price decreases, right? Price from this point to this blue point, right? But duration is telling you this will be the price. Isn't that right? Again, your loss is it overestimated or underestimated? Loss is. So your actual price is actually here, but duration is saying your price will be here, down. So loss is. Am I losing you?
The original price is actually above.
Exactly. So that means the duration measure is saying price will be lower than actually it will be. So loss is overestimated. Isn't that right? You guys following me? So when the yield decreases, what do you expect to the price to happen? Price increase. Of course, it increases, but if you use only duration cannot capture the total increase. So your gain is underestimated, right? Similarly, when yield increases, what do you expect to happen to the price? Price goes down. But if you use only duration, it tells you it will go down even more than it actually will. So your loss is also overestimated, right? It says duration, price will. I know it is not very easy or straightforward to process, but this is a very beautiful feature of conventional bonds. We call it positive convexity. Why beautiful? Either way, as an investor, if there is a positive convexity, you are gaining. Isn't that right? Look at this formula. Positive convexity is positive. If interest rate increase, you will lose money, right? But because of the positive convexity, it will be offset. If interest rate decreases, of course, you will gain money. And this will be amplified because of positive convexity. You guys see what I'm trying to tell you? So this chapter is all about duration and convexity. Okay. So duration alone provides a close approximation for price changes for very small yield changes. For very small yield changes. For larger yield changes, we need to account for convexity. If convexity is positive, it reduces the price impact of an increase in yield and accentuates the impact of a decrease. I already mentioned that. Convexity is positive for most instruments except for instruments like MBS, mortgage-backed securities. I already discussed this. Callable bonds. What are callable bonds? In a way, it is like opposite to mortgage-backed securities. In case of mortgage-backed security, if you are a mortgage owner, if the interest rate goes down, you will hand over the mortgage loan, right? And you will refinance. In case of callable bond, what happens? Let's say you are the manager of a company. Market interest rate is very high, but you think it will go down in future. That you include a call provision. You say, after the next 5 years, if I want to, I can pay you back. Okay, even though the bond has a 10-year maturity, after 5 years, I reserve the right to pay you back. And of course, it cannot come for free. That has to be compensated with a higher return, higher coupon for the bondholders, right? So again, it is then contingent, right? It has contingent cash flow. So these have actually negative convexity. So all else the same, investors prefer instruments with positive convexity. Now, there are many kinds of duration. We already saw D is the duration, right? And we already saw how to find out duration by observing different prices at two different yield levels, right? P minus minus P plus divided by 2 delta P. Those kind of formulas, right? So there is another duration, which is called Macaulay duration, which is interpreted as a weighted average of the time until each cash flow will be received. Now, when you hear the term duration, without thinking in technical terms, you may think it is the same as maturity. Isn't that right? Duration, maturity, right? And you are right. But we want to be technical. When we say duration, we actually include the technical aspect of it. For example, one way to classify bonds are whether they pay coupon. We call these coupon bonds. Another way, zero coupon bonds. For example, the treasury bills, right? They are actually sold at a discounted price. They are not sold at $1,000. They will be sold at a discounted price because you don't get any coupons. At the maturity, you get the full $1,000. So the difference is you return, right? Now, in this case, you are receiving only one cash flow at the end of the maturity of the bond, right? So even if you think about the cash flows, even in the technical sense, for a zero coupon bond, maturity is equal to duration. But if you think about coupon, it has a 10-year maturity, but you don't wait for 10 years to receive the payoffs or cash flows. You actually proportionately receive, right? Some of this you receive in coupons, and at the end of the maturity, both coupon and principal. So actually, Macaulay duration captures this aspect. That's why they're saying it is a weighted average of the time. And you will see when we calculate that in Excel, each cash flow received with the weights based on the present value of each cash flow. And I'll unpack this formula when I actually use it in Excel to avoid repetition now. So longer maturity bonds have higher duration. Again, why? When we calculate this, actually you will see it more clearly, but because weights based on the present value of each cash flow and the weights are multiplied by time. So if you have a longer bond, then you'll have a higher duration. You have more time to be incorporated into this formula. For example, if you have a 10-year bond, you will have 10 such cash flows, and each cash flow will be multiplied by 1, and then 2, and then 3, up to 10. So longer maturity bonds have higher duration, and intuitively it also makes sense, should make sense to you, because duration is just technical aspect of maturity, right? When we say maturity, we do not think about whether we are receiving cash flow partially over time, right? We ignore this aspect, right? But in duration, we actually incorporate that. If we receive cash flow, we actually calculate that in our duration. That's why for coupon bonds, duration will be lower than the maturity, right? Does it make sense? Because you are actually receiving some of the cash flows over time, right? Okay. So bonds with lower coupons have higher duration because the final repayment of principal at maturity accounts for a bigger portion of the total value. Zero coupon bonds duration is essentially equal to their maturity. I already discussed that, right? Because there is just one cash flow. Now, impact on returns if rates rise or fall. Whether an investor win or lose if rates rise or fall depends on the relationship between the investment horizon and the duration of the portfolio. If rates rise, the portfolio will suffer an immediate capital loss as bond price decline. But subsequent cash flows can be reinvested at higher rate. Over very short horizons, the capital loss will clearly outweigh any benefit from reinvestment. Again, what is reinvestment? What does it mean by reinvestment here?
Plugging back.
Hmm?
Plugging back.
Plugging back what?
Interest coupon.
Yeah. Tell me more. Yeah. Yeah, coupons are reinvested, right?
Yeah.
Because you get coupons periodically and then you'll reinvest them at the prevailing interest rate. So they're saying over very short horizon, that means if you sell the bond immediately, right after the price interest rate changes, you will incur the capital loss if it is an increase in yield. In that case, capital loss will clearly outweigh any benefit for reinvestment because you are not invested in the bond anymore. Over extremely long horizon, reinvestment opportunities dominate, right? Okay. Under some simplifying assumptions, the capital gain or loss is offset with the reinvestment loss or gain from a rate decrease increase if the investment horizon is equal to the duration of the portfolio, right? If your investment horizon is equal to the duration of the portfolio, then the increase in bond price due to a decrease in yield will be offset by the decrease in reinvestment income. You guys following me? So what they're saying, if investment horizon equals to your duration, then what happens? Let's say rates increase. If rates increase, what will happen? Price decrease. But then what will happen to reinvestment income? If rates rise, you will reinvest the coupon at a higher rate. Reinvestment income will increase. Is that right? This is what they're telling you. Under this condition, if your investment horizon, how long you want to hold on to the portfolio is equal to the duration of the portfolio, then these will offset each other. So that is for rates increase. If rates decrease, what will happen? Price will increase, but that will be offset by decrease in reinvestment income. So that is a fundamental factor for an investor portfolio manager in managing interest rate risk.
This is a situation where in the investment horizon is equal to duration, right?
Duration of the portfolio. if that is the case.
If it doesn't equal.
Then no, this will not hold.
So this assumption is just based on this, right?
Yes, so in other words, it is telling you if you can construct your portfolio in a way that the duration is the same as how long you want to hold on to the portfolio, then your portfolio will be managed in terms of interest rate risk. Right? Regardless what happens to the interest rate, you don't care. Because one income will be offset by the other loss and vice versa. Okay. Now, the term structure of interest rates. So what that basically means, if you invest, you can invest, let's say, in a 1-year bond, 2-year bond, 3-year bond, right? And generally what happens when you invest in a longer term bond, you get higher rate of return per year. So your term structure looks like an upward sloping curve. So let's say this is maturity. And this is your yield. 1, 2, 3. Let's say this is your interest rate per year. This is your interest rate per year. This is your interest rate per year. If you plot them, this is an upward sloping curve. Isn't that right? So, and this is what we all like actually. If it reverses, it is a dangerous indicator. We have to be very, very careful. And that is a different type of discussion, but yes. So term structure of interest rates, plot interest rates for each year for different maturity bonds. Term structure of interest rates is also called yield curve. Okay. Movements of the term structure are undoubtedly the biggest driver of overall fixed income returns. Okay. And there are many ways that this yield curve can change depending on the economic situation. The 3 major components are shift, twist, butterfly. Okay. What is shift? In that case, that yield curve will increase or decrease in rates at all maturities by the same amount. So it is parallel shift. For example, let's say increase. So that means it will be then like this. Or decrease, then it will be like this. This is a twist. This is a shift. Or twist, a rotation of the term structure, creating a steeper or flatter curve. Flatter, steeper or flatter curve, meaning, let's say it can be steeper this way, or it can be flatter the other way. Okay. Now remember, shift accounts for roughly 90% of the volatility of interest rates, twist only 5%. Now another is butterfly, changes in the curvature of the term structure with middle maturity rates rising or falling. So let's say this is 1, 2, 3, only interest rate in this maturity will change. Others will relatively remain same. So then we will have a butterfly impact. And that actually explains only 2% of the volatility. Okay, so good thing is, actually we can see that in an Excel much more neatly. So go ahead and download this Excel file.
Can I give 1 minute?
Yeah. Just waiting for Edward. So what you see, everyone was able to download this, right? Okay. So the current interest rate is flat, the yield curve, right? Regardless, the maturity, it is always at 3.5%. To keep things simple, right? That's why you see 3.5% here. Now, shift. Again, what is shift? Equal increase, right? Or decrease. So let us enter 1% here. See what happens to the curve. It goes up equally by 1%. That is what is called shift. Parallel movement, right? You can also say negative 1%. It will shift downward by 1%, right? Okay, now this is our shift, and I'll go back to 0%. Now, what is twist? It says twist is rotation of the term structure, creating a steeper or flatter curve. So let's see what happens. Let's, in case of twist, positive 1%. See what happens? It becomes steeper, right? Now, negative 1%, flatter, right? So this is what it means by twist. Okay. Now, what is butterfly? Changes in the curvature of the term structure with middle maturity rates rising or falling relative to the short and long maturities. Now, middle maturity in our case is, if you click on this is our middle maturity we are assuming. Okay. So now let's say if we do a positive 1% here, see what happens? Relative to the other maturities in this maturity, the intermediate or middle maturity, it increases. If you use a negative 1%, it decreases, right? Okay, so this is what is meant by movement of term structure of interest rates, right? And this is a very, very simple example. Think about the real world situation, right? It is so complex, right? So complex. But again, this simplified version of the real world helps us to understand intuitively what we can expect under what conditions and position our portfolios accordingly, right? Joa, you're good? Now I will go back and enter 0% to all of this and save it. So we all understood then what is meant by term structure of interest rates, right? And what are the components? Okay. Now what we want to do, we talked about duration and convexity, and then how to find out the approximate returns using duration or using both duration and convexity, right? So let us try to calculate that in our Excel. Let's go to duration template. And we have a note here. This N means note. It will mature in March 2021. It has a coupon rate of 2.375%, $1,000 per value. Okay. Now what we are going to do, go to this cell, enter equal. Yeah, here, and then we'll go to term structure. Select this. Okay, now what we are going to do, pull across without formatting, so that our formatting remains intact. And then pull down. It will look very vicious. So I'm going to fill without formatting. Is everyone good? Okay. Me, you are good?
Yes.
Now, so this is today, right? That's why you see 0 here. So our first coupon will come here, right? Right, after 6 months. And how do we calculate coupon?
Percentage of face value.
Okay. Face value
Percentage. It's probably percentage.
times
Interest.
rate. Okay. And then I want to move across, right? So I'll lock the column only. And because these are semi-annual, what I'm going to do, divide by 2. Okay. So let me actually use the parenthesis here. It will not change anything. Okay. And then I also want to lock the face value, isn't that right? The column only. Okay.
So the formula.
Now, We'll pull across without formatting. Are we missing anything, forgetting anything? So it matures in March 2021. So what are we missing?
The face value.
Yes, very good. So we have to include this under this face value, right? So now we are going to find out our total cash flows, sum of these two. Okay. Pull across, yes. And then if we want to calculate present value, how do you do it? What is the formula for present value for single cash flow? The future value at the end of nth year is equal to present value times 1 plus interest rate raised to the power n. Isn't that right? We all know this formula, right? From your time value of money. So that basically means our present value will be future value divided by 1 plus r raised to the power n, which is the same thing as future value times 1 plus r raised to the power negative n. Isn't that right? We can use a negative exponent instead of dividing, right? Okay. So equal to our future value times open parent 1 plus. Where are the interest rates we need to use? So that is the coupon rate, which doesn't change. We need to use market interest rate.
Back on the term structure.
Exactly. We need to go to the term structure, right? So this is our interest rate. Now close raised to the power minus, come back to duration, raised to the power n. This is the time, right? Mhm. Let's see if I can make it bigger.
Yes, thank you.
You're very welcome. Is this good?
It's better.
Better? Okay. Is it good?
Okay.
Come to the middle desk. There are so many empty desks.
I need to charge.
So now we are going to pull across without formatting. So what should we enter here?
You just show.
Yeah. Mhm.
I got different. Oral thing that.
Make sure in the term structure, you have all this 0.
Except the first one, right?
Yeah.
0.
You have 0. Okay, let me have a look quickly. Oh, you need a minus, right? You are calculating present value. It's probably not easy to see from there. Yeah, and do it else. Now, I was asking, what do you think this cell is for?
Outflow from 8,000.
Outflow? So tell me, what did we calculate here? Present value of all future cash flows from this bond. So if we sum them, what do we get? Price. Right? So that is what we are going to calculate here, price of the bond. Okay.
Is it?
Yeah.
So.
Now, let's go back to our duration formula, macula duration to be more specific. So this is the formula, right? Let's unpack this formula a little bit. So it says our macula duration is this. Now, one over present value, right? We calculated the present value already, right? Now, within the summation, what do we have here is present value of AI, right? Times TI. So present value of A1. And what are the AIs? Denotes the cash flow at horizon, right? And then multiply by T1 plus present value of A2 multiply by T2. It goes on, and in our case, in the Excel, how many do we have? 6, right? It goes on until the present value of A6 times the T6, right? Okay. So this is what you get if you unpack the formula. So what that also basically means, because it is a common factor, you have to distribute this with each of them, right? So that basically means if you multiply this with the first term, it will be like present value of A1 divided by total present value times T1 present value of A2 divided by present value times A2, T2. it goes on until you have present value of A6, present value times T6, right? So this one multiplied with this, plus this one multiplied with this, right? Now, when you multiply this one with this, what happened? I just wrote it in a different way. Present value of A1 divided by present value times the T1, right? Now, what you see here is weighted average of the time. These are the time, T1, T2, up to T6, right? And weighted average. And the weights are based on the present value of each cash flows. Isn't that right? Present value of each cash flow. Right? So that is what it means. You guys with me so far? Okay, so we are going to implement that in our Excel. So first we are going to calculate the weights, this X. And how can we do that? What do we have to do? You can try to relate the formula. What is our A1, A2, A3 in this Excel? What are these values?
First coupon, second,
Sorry, say it again.
first, second, like then coupons.
First, second what? Coupon. Coupon, which one? Can you tell me specifically? You mean this one?
Yeah.
So you are almost right. These are present value. So yes, you are right, coupon, but not the coupon, the present value of the coupon. And not only coupon, the total cash flows. So these like, okay? So these are the AI. This, and then divide by what?
Nine one.
This one, right? Present value, right?
Okay.
Okay, very good. And then we are going to log the column. Pull across. Okay. Now we are going to check if we sum all of this, what should we get? One, very good.
Without formatting? Or just.
Without formatting, yeah. Now we are going to multiply with the time. What are the times here,
0.3.
Preston?
Row 8,
So
is it row 8?
row 7.
Sorry.
0.5. No, you're good. Yeah, there are two rows with time. So yeah,
So the one, is it, we just enter one or we?
no, it is the sum
Just
of
some
all the weights.
So, okay, some following.
Is it raining?
Yes, almost.
I guess we can stay longer than today, right?
Sleep here to be safe.
Huh?
Stay here to be safe.
Yeah. I saw there was a flood warning or something. What can happen? Worst thing, we'll just party tonight. I'm sure one of you can sing, right? No? Edward, you can sing, right? Okay, now we are going to multiply these weights with the time. And then what is the last step?
Sum?
Sum, very good.
Do without formatting also?
Without formatting, yeah. Whenever we pull across, we'll use without formatting.
So what does the 2.9 mean?
That is the value of duration. Now, but there is a deeper question here. How do we interpret it? See, this bond matures in 2021. What is the maturity? 3, right? But that ignores that cash flow is partially coming over time, right? It's not just you are getting all the cash flow at one time, unlike zero coupon bond. For that reason, zero coupon bonds duration is the same as maturity. Now, how to interpret this? Look at the formula. I don't have the formula here for the percentage price change. So that means if there is a 1% increase, parallel increase in the yield curve, then bond price will decrease by 2.912%. Right?
So minus 2.9.
Yes, because bond price and interest rate are negatively correlated, right? That's why also you see a negative sign in the formula. Right? Okay. So now what we are going to do, we are going to copy this, Control C, and paste as value here. So no change, 0.00%, right click, values. This 1, 2, 3 is values. Now, this is set up correctly, right? Now, what is our formula to calculate duration? So this is our macula duration, right? But we need to calculate duration this way. We need to find out what happens to the price if yield decreases, increases, divide by 2 delta price. Okay. So what we are going to do, it says negative 0.10%, right? I'm going to go to the term structure. And then in the shift, negative 0.10%.
1%.
Negative 0.10%. So all these will change, right? And then that will also change the bond price. And because yield decreased, bond price increased. Do you get 971.79?
Why did you?
So I decrease in enter, yeah, in the shift I enter negative 0.10%.
It did not change.
For you did not change?
Mm.
So let's see.
For the shift, negative 1.
Yeah. We have 996. This is 969.
So it should not be.
Let's see, oh, this should be minus 0.10%, okay?
Okay.
We'll go to duration. Yeah. Is that going good?
Okay. That's just 1%.
Yeah. Now, I'm going to copy this, paste here as values. We will do the same thing with positive 0.1%. Make sure you're getting the same prices.
Hold on, can I see the 971.79?
This one,
Yeah,
I just copied.
yeah, I know, but why the number change?
Say it again.
Why is the number change?
Why the number changed?
Yeah,
Which number?
the total,
You mean this one?
yes,
Yeah, this is the number I copied and pasted here.
You go to term structure template. This one?
Or you are asking why did that number change?
Yes,
Or you go to term structure and then enter -0.1 in the shift cell.
oh, I see.
Yes,
Oh, it's mine different, it changed different.
make sure it is -0.10%, not -1%.
Oh, thank you.
You got it now?
Yes,
Okay, very good. So now go ahead and do the same thing, but for 0.10% now. In the shift.
10%. You can make 10.
You have to type the percent manually.
Oh, okay, 0.1%. 0.10.
0.1%.
Okay.
Now, what we are going to do. We are going to calculate the actual price changes here and here. Because these are our actual prices, right?
So
From the present value analysis, huh?
966.
Yeah.
It's give me,
These, you're getting different number.
yeah,
You have 0.1% here.
yeah, 0.10%. Yes, that's right.
Yes. And how much do you get here?
I got 969.
So remember, make sure it is a positive.
Yeah, it is positive. That's what I meant.
Positive.
0.10%.
Okay. So, well, you have to, you also use twist, so it has to be 0%. Okay.
I can put it on.
There you go.
Space.
Or whatever. 971 is now, what he will do, positive 1% in the
Okay,
same.
the same shift. Oh,
same,
okay. I
yeah.
think I did it for the twist. Oh,
Yeah.
Okay. It is gonna be like.
So now, copy paste.
Yeah, we're right. So you're right over there.
So. We are going to change the percentage price change. How can we do that? Just P minus divided by our original P, right? And I will lock this column. And then -1. Copy, paste as formulas here. Now our duration will be, this is the formula.
Paste, oh, from.
Say it again.
I got it.
Where did you get the second one?
And then I'll-
Say it again.
Where did you get the second one? Like.
This one?
This.
So I copied, so Control C, right click as formula. Yeah.
let me see.
So now in the duration, we need equal open parent. Our P minus is, which one is P minus?
Yeah, that's one.
That's one, okay, very good. Minus P plus is which one?
The first one.
Okay. Divided by 2 times delta. Delta are these, right? So delta times our original P is this. Now what we are going to do, we are actually going to use not B18, we are going to use D18 to avoid the negative sign effect. Okay,
Well,
D18. Okay. So that is our duration based on that formula, right? This was macula duration. These are called actually effective duration formula. But yeah, so and then we are going to calculate convexity. And you have a question?
You got negative.
Yeah, so I actually at the last moment I changed this from B18 to D18.
Okay. D.
Yeah,
Okay.
D18. Make sure you have D18.
Thank you.
No problem. So now C convexity is this, right? So equal open P minus 2 times P plus P plus closed parent divided by open parent delta squared. So these squared times P. Yeah, make sure you write this formula on your formula sheet. For exam, I mean. Okay. Now, based on, you have a different number?
yeah, 10.81
B19 minus 2 times C19
plus D19. We got it divided by D18 with the power 2 times C. Okay, C, okay.
Now, based on these, how can we find out percentage price change? Remember the formula, the original? So this is how to find out percentage change in price, right? Based on duration and convexity. So equal minus our duration times change in yield plus half, which means 0.5, times our convexity times our delta y squared.
Two times D.
Okay. Now, what do you notice from here? Again, remember these prices come from actual prices because they're based on present value analysis, right? Detailed discounting. And based on that, actual price changes negative, 0.2819% if yield decreases by 0.10%. Yield increases by 0.2808%. Right?
Can you click it again on,
This one?
can you
Yeah.
click on the one again?
Right, very good. So what do you see? Do you see a very close approximation or very far? Which numbers are you comparing again here? Making sure that you're following me. Which two numbers will you compare?
320 and 323.
So
Be positive in everything.
D20, yes, very good. And D23, right? Very good. This is based on duration and convexity. This is based on actual price change. They're very close to each other, right? We can go into more decimal places to see where they differ, but you get the idea. For a small change in yield, this formula is very good approximation. But what if yields changes at different level? For example, we'll explore this here. So here, I will write down in this cell equal to structure, this original interest rate. Then I'll come here.
Can you zoom it bigger, please? Sorry.
Okay.
Can I see this one again, please? The
Yeah.
Y32.
Mhm.
Thank you.
You're very welcome. Just buy us lunch. Dinner time, actually. So you don't have to. Right? So this delta, let's say equal to minus let's say this one. Yeah. And then in the next cell, this plus this log this cell divided by 6. I'll explain.
Where did you get the negative 3.5 again?
From here.
Okay.
Yeah, I entered a negative sign in front. Actually, here instead of B26, use this one and lock.
32.
Mhm. Okay. And then pull across without formatting. Now, actually, we are increasing, right? At equal, by equal value. That is what we did. Okay.
38 to
38, yeah.
38.
Yeah. Now here, our yield will be then this. I will lock the row plus this B26. Right? So this is our original yield, and we are going to evaluate the bond price at each level. So this is the original yield, this is by, this is delta Y, right? So this is our new yield. Okay. Cool down up to 31 without formula, without formatting. And then copy this. See. Highlight, right click, paste as formulas.
Can you go back up to I-26?
Yeah.
Must be term. For some reason.
Yeah.
Okay.
Yeah. Now pull down up to 31 without formatting. Now copy, do not overwrite here, 32. Control C.
Have a different figure here.
Hmm?
Have a different value.
Do you have the same numbers here?
Minus 1.8. Yeah.
Okay, now, do you have the same thing here? Did you lock A32?
Is it 832 by just the
The row,
row?
Yeah.
Yeah, was B26, right?
right?
Yeah, that's what I did.
Okay, and then pull down up to this 31.
Could you please show the formula for B28?
It's the difference.
B28?
Yeah.
So make sure this is what you have here. You have to pull down from B27.
Till B38, right?
26
Yes,
That is giving different
divided
number.
by 6.
let me have a look.
Last one is correct, but this one, 4.1, the last 2.9. This one is also.
So let me see here. You're having the same, right? Yeah. Now.
Mine. These are correct. This one. And the same value as yours.
Okay,
And here, it's the same thing.
so. Let's see what I did here.
First two.
Mhm.
This is the first one.
This one is A32. B26. Okay, so you need to lock the row, you locked the column.
Mm,
Functional. Go ahead and lock the row only. and then copy paste this one. Highlight, right click, formulas.
Mhm.
Okay. Is everyone good so far?
Not yet,
Okay. So now
not yet, not yet.
we have to find out the present value of the cash flows using this discount rate, right? Using this interest rate.
And when I copy a paste as values or just paste,
Which one? This one?
yes.
It should be formulas. Yeah, paste as formulas from here. Copy this and paste as formulas. Now here, equal to our total cash flow is this, right? Times open parent, 1 plus our interest rates coming from term structure. This flows raised to the power minus, come back to duration this time.
Is 0.5?
Yes. Yes. Now, we want to be able to pull down, right? And pull across. So what we are going to do, you have a question?
C10, it's a C7.
Yeah, minus C7, yeah. So what we are going to do, we are going to lock the row for C12. So that when we pull down, it doesn't move, but when we pull across, it moves. Similarly here, we are going to lock the row. And similarly here, right, we need to lock everything, right? Because these do not change. Our total cash flows do not change. So C11 needs to be locked completely. No, not completely, sorry. Because we still want to move to the right? So it should be locked only row. We still want to move to the right. What's the problem?
So I'll just to lock just the rule. I just lock everything and then.
Oh, I see, yeah. Okay, actually made a mistake here. These are the new rates, right? So these are the new rates. We need to use the new rates, not the term structure. I think I mentioned that, but I forgot to use them. So this formula, we are going to use this and lock only the column. Okay. And then also, actually, we don't need to go to C7 because we already have it here, right? So I'm going to use C25 instead of C7. Okay. You guys did you get 11.9? Yeah. Yeah, okay. So now let's see if it works. Pull across up to 3. Yes, we are good. Pull down without formatting.
My 3 is not good.
Your 3 is not good.
No, it shows 11.9.
Okay, so make sure you have this. Do you have this?
I do.
You do. Let's see. Okay. Something is happening. So you locked the column. You should lock the cell. This is C11.
Oh, it's completely?
Yeah, so you should lock only the row, not the column,
Oh,
right? Because you want to move to the right for each of these three, right?
there we go.
And then pull down without formatting. Yeah, and entirely, you can do entirely in this case.
The whole thing?
Yeah, the whole thing, yeah. So how will we calculate the price then here? What will be the price? Sum of these cash flows, right?
Huh? No, it's still wrong.
It's wrong.
Yeah. 600.
Let's see. So you have C11 and then A. Okay, so you need to lock column, that's correct. And then you need to lock the row for C25.
Same.
If you get it correct now. Yeah, okay, very good. So price is just the sum, right? Okay. And then how you have a different?
No. No, I'm good.
You're good, okay. So
The formula, one more time.
This one?
Yeah. Page 26. Okay.
okay, and then delta P over P is percentage change, right? So this one divided by what is our original price? Our original price was this, right?
10.1.
When the original yield to maturity was 3.5,
Oh, okay, yeah.
right? And the log, you can completely log or you can log only the row. Go ahead. And -1.
It's not like the total price, it should be the P32, not X32.
So this is, oh yeah, you're right, actually, very good, very good. Yeah. This is not the price, this is the price, which I did not calculate yet, right? Very good. Thank you, Mi. So because we don't have any numbers, it will show like this. For now, we're good. So now let's, yes, I would,
Yeah, let me see the format again.
yeah. Okay, so now let's highlight this too. Okay. So these are our actual percentage change in price, right?
Yeah.
Now we are going to forecast, not forecast, we are going to estimate based on duration only. And another time, both duration and convexity, right? So equal to open parent. Now, the formula for duration is this, right? The formula for percentage change is this, right? And this is the duration component only, right? And this is a percentage change. So how do we calculate the price? It will be 1 plus the percentage change, right? But because there is a negative sign for duration, I'm going to use an open parenthesis minus duration, which is our duration. This is our duration. And log this completely times our delta. What is our delta? This. So that is it, right? For the duration. Minus D times delta Y. Right? Close parenthesis. Multiply by what? If we want to find out the price. The new price. So let's say it may not be very obvious because of the way I wrote it. So this is your return, right? And this return is coming from where? This return is coming from delta P divided by P, right? And how do you find out then the new price? 1 plus R times the old price, isn't that right? So that is what we are going to do, multiply by the old price. What is our old price? This one. And then we are going to log the row, yes. Actually, I need a parenthesis here, not at the end. You guys followed what I wrote down on the board? What about if we use both components, duration and convexity? equal to open parent 1 plus our return, which is
Can I see the formula?
this one.
Yes. Absolutely, let me see the answer. Yes.
Sorry.
10, actually, I want to see the answer, 1064.5.
Yeah. So open parenthesis 1 plus open parent minus duration log times our delta close times actually no, so that is just the duration part, right? Plus 0.5 is the half times our convexity, which is this log times our delta squared. Now we can close.
Can you zoom a little bit more, please?
Yeah, let me finish this and then I'll zoom and then multiply it by the original price. What happened here? I don't need one decimal parenthesis. So. Is this good?
Yes.
Hmm? You are good,
Yeah.
Yeah.
Thank you.
Edward?
Yeah.
You will get the same numbers?
69.9, 0.
Okay,
And then,
you are not?
no, wait.
Okay.
Without formatting?
Without formatting, yeah. Make sure you have the same numbers.
Yeah.
Okay, very good. Now, let's see how they compare. We have another table to complete here, but this one is much easier. We are going to come here. This will be my, so this is calculated already for you, right? And this is coming from this column. This is coming from this column,
Okay.
and this is calculated just like we calculated here, right?
Mm.
So what that basically means, based on actual price changes, if there is a negative 3.5% change in the yield to maturity, negative,
Positive.
you expect 10.55% increase in return,
Mhm.
right? or bond price. But based on duration, is estimated as only 9.85% because it is ignoring convexity, right? If you include convexity, it is getting closer, but it's still a little bit of difference, right? We want to show this difference. So here, this will be my D minus delta P by P log column. Okay, and then pull down, pull across, and then pull down without formatting. And you should have this nice chart here, right? Yeah, okay, so let's focus on this chart. Does everyone have this? Yeah, very good. So I have this here too, this chart. So this curve, right? Black, that is our actual price change, right? And this estimates the difference based on duration, the difference based on duration and convexity. Now, actual price change is on the left axis, right? Duration convexity on the right axis. Now, what you see when duration, and this is yield changes, right? At this point, no changes. That's why everything is at the origin, right? But if yield decreases by 0.5%, there is still difference. Sorry, there is not much of a difference, right? Because this is what? 0%, right? So remember again, this triangle is duration based, and diamond is both duration and convexity, right? So for a smaller change in yield, you can, even if you include only duration, you are still good, right? But as the yield decreases, or I mean, the magnitude of yield increases in either direction, duration is not enough, right? Because the difference widens, right?
Yeah.
You guys see what I'm saying? But if you use both duration and convexity, yes, it is not perfectly on this line, but still the difference is very small compared to only duration and convexity. You understand, everyone? So this line, this black line, okay, maybe I can go to the Excel, maybe that will be. So this black line is this, right? And this is plotted on the left y-axis. And this yield are this, right? Changes in yield. And these are the differences from actual price changes, right? We want this to be very close to 0, isn't that right? So that is what it is saying. When you use duration and convexity, even at higher level of yield changes, we get very close estimate. But if you use only duration, then they increase as magnitude of yield changes increase, either direction, negative or positive, right? Yeah. So that basically just saying, in summary, that we need to capture both duration and convexity for larger magnitude of changes in either direction, okay? Okay. Now, what we have to do, let's talk about some fixed income strategies. So fixed income manager, right? What they do, they try to anticipate how the slope of the term structure will change. This is the term structure, right? No change. I'll enter 0 here. Now slope changes with a twist, right? Because shift is same level of change, remember? Same amount of change, right?
Yeah.
Shift.
Yeah.
But twist is slope changes, so this, right? It steepens, it flattens, right?
Yeah.
Okay. So fixed income managers, they want to forecast how yield curve will change, especially their slope. And then based on that, they have they create their position, right? Portfolio position. Suppose they anticipate that the term structure will flatten without a change in the overall level of rates. Okay, they will flatten. So let's say this is our normal upward sloping term structure of interest rate. Now, it can flatten in many ways, right? This is one way it can flatten. Now here they're saying specifically short-term rates will increase. So it will not increase this way, rather short-term rates will increase and long-term rates will decrease by the same amount. I didn't draw it properly. So let's say this is the middle point. So it flattened, short-term rates increased, long-term rates decreased. And can you think of economic situation when this can happen? Short-term rates increase. The situation we are in. Economy is overheated, inflation is high. We want to reduce the inflation, we increase the interest rate, right?
They're thinking about decreasing the interest rate though.
Sorry?
They are thinking about
Yeah,
decreasing the interest rate.
yes, that's true, yeah. Because of the labor market condition,
Yeah.
right?
Mm.
So, so this is flattening. One way to flatten the yield curve. Now we can think of two strategies. One is bullet. Buy an intermediate maturity bond. Intermediate maturity, because see what is happening. Short-term rates increasing, long-term rates decreasing. The overall yield to maturity is not changing, right? That is the idea. So this is our intermediate, right? Because there is no change, so we can have a bullet bond. Our return will be protected. So that is the idea behind bullet, okay? But another strategy is barbell. Like you go to the gym, right? You have barbell. They're saying buy a combination of a short maturity bond and a long maturity bond such that the value weighted average of their durations equal the duration of the intermediate bond. So you have, let's say, one short maturity bond here, another long maturity bond here, right? And that is your intermediate bond. If you invest only in the intermediate bond, that is your bullet strategy, just one bond. Barbell is, you have two positions.
Okay.
One is short term and the other is long term. But you have to construct in that way, the duration of the bullet equal to the duration of the barbell. So what that basically means, what do you think? Which bond, the shorter bond or longer term bond, will have a higher weight in the barbell? Longer, isn't that right? Does everyone see it? Right? Because it has a smaller duration than the intermediate. To capture that lag, it has to weight higher, right? The long term. Okay, so these are two strategies we want to explore. So let's say after the term structure flattens actually, as per our anticipation, by construction, what will happen? The value of the bullet position will not change, as we said, right? Because interest rates is not changing in the intermediate term bond. In case of barbell, the short maturity position, what will happen? Short-term interest rates increased, bond price decrease. So the barbell will lose money. So the short-term maturity position within the barbell will lose money, while the long maturity position will gain because long-term rates decreased, right? However, the higher weight for the longer-term bond than the shorter-term bond within the shorter-term bond within the barbell will cause the long end of the curve to dominate because you have higher weight in the longer-term bond. As a result, when the curve flattens, a barbell usually outperforms a bullet of the same duration. The thing is same duration. So when you have a same duration, your interest rate exposure is the same. But because of the unique position of the two bonds, both short and long term, you actually will outperform. Conversely, if the term structure steepens, the bullet will outperform the barbell. If it steepens, right? So that means this, right? Short-term rates will decrease, long-term rates will increase. Because barbell has a higher weight in the long-term bond, it will lose more. And it will underperform. Barbell will underperform the bullet, right? So if we consider only during, suppose all yields rise or fall by the same amount. Now we are talking about, we are not talking about twist, we are talking about shift, same amount. I will not hold you longer, just a few minutes. So this is about slope changes, so it is twist, right? Now we are saying that forget about twist, think about shift, so parallel shift. So if yields rise or fall by the same amount, rise or fall. If we consider only duration, the bullet and the barbell will have the same return because they have the same duration. Remember, I said how to interpret duration. If duration is 5, then if there is a 1% parallel shift in the yield curve, upward parallel shift, return will decrease by 5%. If there is a downward parallel shift, return will increase by 5%, minus d times delta y, right? So because both bonds have duration, same duration, their impact will be the same. If we consider only on duration, but duration is not the full picture, especially for larger change. However, convexity increases more rapidly than duration as we extend maturity. Therefore, the weighted average of convexity of the barbell will exceed the convexity of the duration matched bullet. Right? According to equation 9, higher convexity implies a higher return, regardless of the direction of the yield shift. Generally, what we say, yield increases, bond price decrease, vice versa. But convexity is such a powerful feature and beneficial thing for investors, regardless what happens to the yield, increase or decrease, positive convexity causes the bondholders to benefit. Okay. Now, as an investor, when you work with a portfolio manager, you can have different types of mandates, like you saw in case of equity portfolio management. One is total return mandate. In this case, the manager is not required to address the client's liquidity liability explicitly. Rather, it entails matching or beating the return on a standard benchmark. For example, let's say S&P 500. Beat the benchmark by 1% annually, let's say. But structured mandate, the manager must customize the portfolio to the specific characteristics of the client's liabilities. For example, a defined benefit pension plan. What is a defined benefit pension plan? Does anyone remember? Defined benefit, defined contribution. Defined benefit is an obligation for the company, right? So it is a liability. So every year, for a mature company, every year employees retire, they claim benefits. So there is a fixed or predictably fixed amount of liabilities or cash flows they have to generate. So the portfolio, fixed income portfolio, has to make sure that amount of cash flow is generated. So that is what it means in this kind of mandate, a structured mandate, the fixed income portfolio manager has to match the cash flows too, which is a much more difficult task, right? Because when the cash flow is needed, cash flow needs to be generated. That is what it means by customize the portfolio to the specific characteristics of the client's liabilities. Institutional clients, they hire outside managers for this purpose, structured mandates. However, institutions with complex liability structures, such as insurance companies, often manage their fixed income portfolios in-house to better align assets with their specific funding needs. What that basically means, what is the business of insurance company? They collect premiums, right? And what is that is their assets, actually, that is the liabilities. Okay. So yeah, the premium, they collect the premiums. So that is the asset side of the portfolio, but they have to meet the liabilities. For example, whenever there is a claim, the insurance company has to pay. So they have to invest, they have to manage this asset side of the portfolio in conjunction with the liability side of the portfolio, so that if there is a claim,